The market isn't crashing. It's being cleansed. If you're staring at your portfolio right now and feeling that tight knot in your chest, understand this. You are not unlucky. You are early in a process designed to exhaust you. Bitcoin isn't collapsing. It's hovering. Altcoins aren't exploding. They're decaying, slowly, quietly, painfully. No drama, no fireworks, just silence. And silence is where smart money does its best work. I'm Preyo Promo. I've lived through multiple cycles early exchange chaos, brutal bear markets, euphoric tops, and absolute collapses. I've seen how narratives change, how emotions shift, and how wealth quietly moves from impatient hands to disciplined ones. But 2026 is different. This time, the purge isn't loud. It's calculated. Over the next 15 minutes, I'm going to break down exactly what's happening beneath the surface. Why sentiment matters more than price right now. Why technical levels are controlling psychology, why regulation is not the enemy everyone thinks it is, and why the next 90 days will define who survives this cycle and who disappears from it. The most dangerous market signal. Boredom. Let's start with the most dangerous signal in the market right now. Not fear. Boredom. People assume fear marks the bottom. Panic selling. Capitulation candles. Blood in the streets. But what we're seeing right now is worse than fear. It's disengagement. Retail isn't screaming. Retail isn't buying dips. Retail has simply stopped caring. Search interest for crypto has collapsed. Social engagement is gone. Group chats are quiet. The hype machine is dead. And when no one is paying attention, prices don't bounce, they bleed. This is the phase where people stop checking charts, where they stop watching videos, where they convince themselves that maybe crypto just isn't worth the stress anymore. That's not coincidence. That's the shakeout. The altcoin extinction phase. Altcoins are the clearest victims. When no one is talking about them, there's no liquidity. And without liquidity, price doesn't rise, it rots. Most altcoins you see today will not see their old highs again. Not because the technology failed, but because attention moved on. Markets reward relevance, not hope. This is the phase where long-term holders are born and short-term dreamers are erased. We are deep in the despair zone, the point where selling feels logical, where holding feels stupid, where patience feels pointless. That's exactly why it works. Market structure controls emotion. Now let's talk about structure, because emotion follows structure, not the other way around. Bitcoin always returns to its long-term average. Always. Different cycles, different narratives, same mathematical gravity. Right now, that gravity is the 200-week moving average. Every major cycle has respected it. Every blow-off top eventually revisits it. Not because the market wants to punish you, but because excess must be corrected. The failed reclaim and shift in trend. We recently failed to reclaim a critical level near 80,000. That failure wasn't minor. It flipped the entire market structure. Former support became overhead supply. Hope became selling pressure. This is how trends change. And while everyone is obsessed with price targets, they're missing the real signal time. Why time matters more than price. Bottoms are not moments. They are processes. Previous cycles didn't bottom in days or weeks. They dragged on, sideways, boring, mentally exhausting. The goal wasn't to scare people out, it was to wear them down. We are not far enough into that process yet. That doesn't mean collapse is guaranteed. It means patience is being tested. The trap of fake rallies. Every fake rally right now exists to create urgency. Green candles appear just long enough to convince people that the bottom is in, that the pain is over, that this time is different. And the moment emotions take over, liquidity gets harvested. These rallies are not signs of strength. They are stress tests. They measure how desperate the market still is to believe. They measure how quickly traders abandon discipline. And most importantly, they reveal where emotional capital still exists. Every bounce invites leverage. Every leverage spike invites liquidation. That's the cycle. If you feel mentally exhausted, unfocused, or emotionally disconnected from the charts, that's not weakness. That's exposure to a market designed to drain attention. This phase is not about destroying accounts. It's about destroying conviction. Funds thrive in this environment because they don't need to be right immediately. They just need others to be wrong emotionally. And most people are the real war. Banks versus on-chain yield. Now zoom out, because price action alone does not explain the pressure we're seeing across the entire crypto market. The real war is not between bulls and bears. It's between legacy finance and programmable money. Traditional banks are cornered. For decades, people accepted zero or near zero returns on savings because there was no alternative. Money sat idle, quietly losing purchasing power, and the system depended on that passivity. That changed the moment stablecoins started offering yield without permission, without paperwork, without waiting periods. Suddenly, capital had options. That's not a crypto issue. That's a banking crisis. When money can move freely and earn more outside the system than inside it, control weakens. And when control weakens, resistance follows. This is why regulation is accelerating. Not because crypto is dangerous, but because it is efficient. Why regulation is not the enemy. Regulation is often framed as a death sentence for crypto. In reality, it's a filter. Unregulated markets attract innovation first, and speculation second. Regulation arrives only after the system proves it cannot be ignored. The pressure we're seeing now is not about protecting users. It's about slowing momentum long enough for institutions to reposition. The irony is simple. Regulation doesn't kill crypto. It kills weak crypto. Projects without real utility, real liquidity, or real users disappear. Infrastructure survives. Networks with actual demand strengthen. This is not the end of crypto's growth phase. It's the end of crypto's amateur phase. The stablecoin capital flood setup. The battle over stablecoin rewards is not minor. It's foundational to the future of finance. If stablecoins retain the ability to offer yield directly or indirectly, capital does not move slowly. It accelerates. Savings accounts become obsolete. Idle money becomes active. Liquidity shifts from legacy systems into programmable rails. But before any flood comes confusion, legal uncertainty, regulatory headlines, conflicting narratives. Enough chaos to scare off short-term thinkers. That delay is intentional, because once clarity arrives, there is no gradual adoption. There is only reallocation. And by then, positioning matters more than timing. Macro liquidity controls everything. Crypto does not move in isolation. It moves with liquidity. When the dollar strengthens, risk assets suffocate. When rates stay elevated, speculation dries up. When liquidity contracts, narratives collapse. This environment is not accidental. It is controlled tightening. But political systems do not tolerate prolonged contraction. Economic pain has limits. Public pressure has consequences. Rate pressure cannot stay elevated forever. The pivot never comes when markets ask for it. It comes when stress forces it. Where smart money is waiting. Smart money does not chase green candles. It waits for exhaustion. That's why large buy orders are sitting far below current price levels. Not in panic zones, but in maximum discomfort zones. These orders are not emotional. They are strategic. They are positioned where retail gives up, not where retail gets hopeful. This is not fear behavior. It's preparation. Bitcoin in 2026, store of value or speculative risk. Bitcoin remains the backbone of the entire crypto market. Its strength is simplicity. Fixed supply, predictable issuance, no central authority, no dependency on narratives beyond trust and scarcity. In 2026, Bitcoin is no longer a fringe asset. It is a macro instrument. The upside is stability relative to the rest of crypto. Institutional recognition. Liquidity depth. Survival certainty. The downside is volatility and patience. Bitcoin does not move on hype. It moves on liquidity cycles. Investing in Bitcoin in 2026 is not about chasing multiples. It's about protecting purchasing power and positioning for macro shifts. It rewards discipline. It punishes impatience. Ethereum in 2026, infrastructure with friction. Ethereum is infrastructure. Not a currency, not a meme, a settlement layer. Its strength lies in adoption. DeFi, stablecoins, tokenized assets, all roads still lead through Ethereum. The upside is dominance. Network effect. Institutional integration. The downside is complexity. High fees during congestion. Scaling competition. Execution risk. Ethereum in 2026 is not a moonshot. It is a long-term infrastructure bet. It rewards builders and believers. It challenges short-term traders. Dogecoin in 2026, culture over fundamentals. Dogecoin is not built on technology, it is built on attention. Its strength is cultural relevance, simplicity, accessibility, community-driven momentum. Its weakness is supply mechanics and dependency on hype cycles. Binance and the exchange risk factor. Binance remains one of the most powerful entities in crypto. Its strength is liquidity, market depth, global reach, product diversity. Its weakness is regulatory exposure, jurisdictional pressure, centralization risk. Using Binance in 2026 is about awareness, not blind trust. Exchanges are tools, not vaults. They provide access, not security. Understanding this distinction is survival knowledge. Should you invest in 2026 or wait? The question is not whether to invest, it's how. 2026 is not a year for emotional buying. It is a year for selective exposure. Blind accumulation is dangerous. Overtrading is fatal. Strategic positioning, patience, and capital preservation matter more than aggression. Opportunities will exist, but only for those who are liquid, disciplined, and informed. This market will not reward excitement. It will reward endurance. Final thought. This phase is designed to make you doubt your intelligence, your timing, and your conviction. That's the test. Those who survive it won't feel smart in the moment. They'll just feel patient. And patience, in markets like this, is the rarest asset of all. Stay grounded. Stay selective. Stay ready. I'll see you on the other side. Are you trading to feel something? Or positioning to become something? If this breakdown helped you see the market clearly, hit like and subscribe to Preyo Promo. Let me know in the comments, do we hit 100,000 first or 50,000 first? Stay calm. Stay patient. Stay ready. I'll see you in the next one.